All right. Welcome back. My name is Seth Golden, and this is part two of the volatility trading complex. In part one, just as kind of a refresher, and if this is your first encounter with our volatility trading series, please go back and check out part one YouTube video. This will give you a little bit of a refresher from what we learned in part one, but what we're trying to do here is understand the fundamentals of the volatility complex, understand what the VIX is, why it is, what it does, and how you can use the volatility complex as a trading tool, if not directly, indirectly in your investing regimen or trading regimen and strategies. So with that, welcome back, everybody. In part one, introduced myself. My name is Seth Golden. Some of you may know me from the New York Times article that was published back in 2017, Day Trading, Wall Street's Complex Fear Gauge Proliferates. One of the things that we touched on in part one was understanding that the VIX is not a fear gauge. It's a volatility gauge. The VIX can crash up in the same way that it can crash down. The VIX goes up when the S&P 500 goes up. It goes down when the S&P 500 goes down. It's not a perfect relationship there. They generally do have a inverse relationship about 84-85% of the time. So if the S&P 500 is going up, usually the VIX is going down. But again, it's not perfect. There is, a good 15% of the time where they will move in the same direction. One of the other fundamental principles that we discussed in part one was in some way, shape, or form, you are participating in the market with volatility. It is the only way to participate in the market. If you're short stocks, in general, you're long volatility. If you're short the S&P 500, in general, you're long volatility. If you are long a stock, if you are long the market, the S&P 500, you are generally short volatility because, as we said before, the VIX and the S&P 500 have an inverse relationship. One of the things that we also tried to do in part one was dispense with some misnomers about the VIX itself. The VIX is not a mean reverting instrument. It is a mode reverting instrument. It just so happens that this has become a popularized characterization of the VIX being a mean reverting instrument since inception. But the reality, as we discovered in this table here of where the VIX tends to spend most of its time is at the mode level between 12 and 13. Spends almost 10% of its time, its life cycle, in that range. Not in the mean range of 19 to 14. In fact, it's way down here, 19 to 20, only about 5% of the time. And that is still a significant portion of the VIX's lifespan where it does spend around the mean, but it's half of what the time that it spends at the mode level. So the VIX, not a mean reverting instrument, a mode reverting instrument. Some of the other nuances that we talked about when it comes to the VIX is obvious that the VIX can't be traded. It's a ticker symbol. It's an index ticker symbol, if you will, but it's not tradable. It is but a calculation. It's a stochastic process that summarizes the value, its own value based on S&P 500 options. It gives you a readout of 30-day implied volatility based on what's transacting in S&P 500 puts and calls. But it is not tradable. And some of the nuances that we also talked about related to the definition of what the VIX is helped us to better understand that doing technical analysis on the VIX, it's futile. There's really nothing you can do it. Why are we doing technical analysis on a stochastic process? It's not even an instrument. We wanted to make sure that definition hit home. It's not an instrument. An instrument you have more pliability with. You can maneuver it. You can do this or that with it. You can't do anything with the VIX except watch and see what it's going to do going forward. But for some reason, and you'll see this a lot in social media, people have decided that it's okay. They can, the VIX will tell them something simply by charting it. And the reality is, the main reason people think that's okay and think it's a fruitful exercise of sorts is because it's a ticker symbol. And for whatever reason, we think all ticker symbols can be charted with efficacy in order to lend itself to our trading, if you will. But the reality is it's the only one that we do this with. It's the only stochastic process that we tend to, lend to some form of technical analysis. And the example that we talked about last time was the 200-day moving average. We're all familiar with the 200-day moving average, whether it's an individual stock, an ETF, or the S&P 500 itself. But there's no ticker for it. I can't pull up a ticker for the 200-day moving average. And therefore, we don't do technical analysis on the 200-day moving average. But because there's a ticker symbol for the VIX, lo and behold. So just to kind of refine, the 200-day moving average is a stochastic, a process measurement. A stochastic is obviously not an instrument for which one can trade. We all agree there is no ticker symbol for the 200-day moving average, and we all agree that we don't chart the 200-day moving average, but simply reference the stochastic process in a trend. For some reason, because the VIX is a ticker, people ignore the logic for all other stochastic process and decide they should and or can chart the VIX for trade relevancy. So again, just kind of revisiting some of the principles, some of the fundamentals, and from our part one of our three-part trading volatility and the volatility complex series. When we're trying to learn something new or trying to hone our understanding of this, that, and the other, we want to do it from the bottom up. We want to get the fundamentals. We want to have a firm foundation of our knowledge, and we can then build upon it. Some of the critical thinking level terms and fundamentals, we want to make sure that foundation is solid. Then we can move on to more abstract ideas and really take our understandings of the VIX, how to trade the VIX complex derivatives to that next level. Right now, fundamentals. And these are some of the fundamental principles that we've talked about recently. And we kind of ended last conversation with an understanding of the VIX calendar. Yep, there's a VIX calendar. It's not a real, thing that you can pin up on your refrigerator, but because of some of the nuances in the VIX complexes regarding hedging strategies and automatic hedging programs, it's evolved to elicit on certain days the VIX will do this, and on other days the VIX will do that. One of the things that we outlined when it comes to this VIX calendar is that Mondays has the greatest propensity for the VIX to be higher. Some 60 to 65% of the time, the VIX is higher on Monday, if not just for the morning period, but for the whole of the day. And the reason for that is because you have these large institutions. They have big, giant portfolios. You have hedge funds and CTAs, and you got risk parity funds. And they've got these large portfolios. They want to maintain their long equity market exposure, but they also want to hedge some of that just in case, because they think that that kind of risk management is necessary. And in fact, in a lot of these hedge funds brochures, they outline their hedging strategies, which include going short S&P 500 options on a weekly basis. And by doing that, with all of these hedge funds and all of these different type of portfolio managers doing this on Monday, they take out weekly hedges. So what is that going to do? That's going to naturally elevate the VIX on Mondays, because you have that kind of volume basically buying S&P 500 puts as their hedge in case the market does go down. Again, they want to keep their long equity market exposure in this stock, that ETF, and the other. But if something happens in the market, they want to have some kind of hedge on. And these are weekly hedges. They do it every single week It's automatic. They don't even have to think about it. Just kicks into gear on Monday morning. And that is why you see on Mondays the VIX higher. And these weekly hedges, when do they roll off? On Friday, which is why you typically see a bigger drawdown on the VIX on Fridays as these hedges roll off. Got my hat on today, Denver Broncos. And of course, I've been a Broncos fan since the 1980s. This is the year of COVID. And what team had no quarterback this week because all of their quarterbacks were in the NFL COVID protocol? The Denver Broncos. I wear it with pride still. It's been a tough couple of years for my Broncos, but nonetheless, that's the volatility that I've accepted ever since Peyton Manning, won the Super Bowl and then retired, and we haven't been able to replace him at the quarterback position since. My acceptance of volatility as a longtime fan, folks. Anyways, moving on. All right, so we got to the end. We started talking about, my favorite subject matter, which is trading the VIX and understanding VIX Futures and the assets that you can trade. Now, you can trade VIX options, you can trade VIX Futures, but the easier way, the most applicable way for the mass investment community out there of traders is to do so through VIX exchange traded products. In most of the VIX exchange traded products, the assets that they have under management, right? So like all ETFs have assets under management. The SPDRs, the SPY for the S&P 500 index ETF has stocks under management. Bonds have different bond maturities under management. Well, VIX ETFs and VIX ETNs, they have VIX Futures under management. The difference between a VIX ETF and a VIX ETN really is about credit. And, there are some nuances that you might want to look into and we'll talk about in the future regarding, the differences there. But for practical purposes, you almost never really have to worry about that. Having said that, we have seen the differences play out since 2018 in a VIX ETF versus a VIX ETN. I trade both. I own both short in the Golden Capital portfolio. And these are some of the most liquid and most popular VIX exchange traded products. VXX is an ETN, an exchange traded note. It comes with credit risk. It's a little bit different than UVXY, which is an ETF, or SVXY, which is also an ETF. TVIX is no longer with us, kind of like XIV back in 2018, because of the credit risk involved in that one, because of the accelerated termination event. It's no longer around. Same thing with TVIX this year. It is no longer around. It terminated earlier this year. It was a double leveraged, as you can see here, 2X stands for double leverage, basically. And all of these are leveraged to some degree. All of these are leveraged to some degree. VXX is just 1X leverage. SVXY is 0.5. It used to be 1X leverage also. It lost some of that leverage, or it deleveraged itself. The fund deleveraged the product back in 2018. UVXY, same thing. It used to be a 2X product, just like TVIX, but in 2018, they deleveraged, which is de-risking the fund, to 1.5. And at this point, it is, the most leveraged. It is the one that I trade more often as opposed to the one I own more often short, which is VXX. So these are just some of the VIX exchange traded products that you can engage with and trade. I began trading VIX exchange traded products back in 2012. I did so at the request of a client. He basically emailed me a prospectus for UVXY. Seth, can you research this? I'm not very familiar, but this seems really interesting. I said, sure. I wanted to appease the client, big money hedge fund, paid for, a large subscription service fee for our company at that time. So I did, initially some legwork. I read the prospectus. I didn't understand volatility back in 2011, 2012. So when I'm reading the prospectus for UVXY, which is developed and known by ProShares, I didn't grasp the concepts very well. I never traded volatility, so I didn't really understand the terminology. I think a lot of it at the time seemed very abstract to me. So I needed a rudimentary, an elementary level understanding. And it took a while. I mean, rereading the prospectus time and time again, then going and watching the VIX in real time, watching, VIX options market, looking at the CBOE, seeing how VIX Futures trade. And I did that for a good 6 months. All of this research that the client had asked me to do, I was doing for about 6 months. And thought I had a better understanding after 6 months and decided to put it into practice. So I started to trade UVXY. Well, in the prospectus of UVXY, it says, these are short-term trading instruments or trading vehicles. And you run a risk if you hold it overnight, you run a kind of a high risk, that you'll see capital losses. And the way that the verbiage is there in the UVXY prospectus, it leads you to believe that this is an instrument that you should be long. You should be buying this instrument. That's the way the verbiage reads. And what confused me during my readings, and just a basic understanding of how the market works, the market doesn't like high volatility, but here's an instrument that basically says you're buying volatility. You're going long volatility. And it's a short-term trading vehicle, blah, blah, blah. So I put it into practice. I bought UVXY. That's what the prospectus says to do. And, you're assuming some type of capital returns. Okay. Now, I understood also that this is kind of a timing thing. So it's not like I jumped right in and bought UVXY. I thought there was, a reasonable pullback in the broader market that was going to ensue. VIX would go up. I'd be able to profit from my long position in UVXY. It did not work that way. Within a month, I was down a good $13,000. I remember this specifically. And that was a small position. So it's, in the grand scheme of my portfolio at that time, it was a good 3%. But I didn't quite understand, and I couldn't quite rationalize the prospectus verbiage and match it with what I see going on with the product, which was decay. It was losing value. Even though the VIX was going higher, so every now and then over the course of maybe the 3-month period that I had put this practice into works, this actual exercise with the product, with real money, real capital, I didn't quite understand what's going on here. I knew something about the VIX futures was involved, but again, the VIX is going up. Why the heck is this still going down? Again, go back to the prospectus, reading the prospectus. So, things started to click. I need to pay attention more to VIX futures and what VIX futures are doing. So I started focusing more on VIX futures, split screens on my, Thinkorswim platform and what have you. And it's starting to sink in that just because the VIX is going higher doesn't necessarily mean VIX futures are going higher. And therefore, if VIX futures aren't going higher, UVXY is not going to go higher. The assets under management are VIX futures. That's what UVXY and VXX are dependent upon. As they go, as VIX futures go, these VIX exchange traded products will go. So that was a learned lesson. Took a little, while to learn that lesson, a lot of consternation, but nonetheless, here we are. So let's talk about these VIX futures. One thing you have to understand when it comes to VIX futures is VIX futures are not VIX options. VIX futures are not any options. The options market trades with a lot of volume. Millions of options are traded daily, let alone just if we focus on S&P 500 options. But that's not the case with futures. Futures have a lot of leverage. There's a lot of, lot at stake there with futures. $1,000 a pip, as they say. So you don't get a lot of volume. There's not a lot of participation in the futures market, let alone the VIX futures market, which is an even smaller market than the S&P 500 futures market. So VIX futures don't have a lot of volume. But the VIX is calculating S&P 500 options, which are trading in the millions, daily, weekly, what have you. So the assets under management, again, UVXY and VXX, assets under management are VIX futures. The VIX itself is not investable, but VIX futures can be bought or sold directly. VIX futures are mostly shorted. Mostly. A VIX futures price represents the market's expectation of 30-day implied volatility of the S&P 500 on the expiration date of that particular VIX future contract. It's a bit confusing just on the face value of this verbiage, but again, the visual aid of the VIX futures term structure helps us to better understand. This right here is the December VIX futures contract. It's trading, well, as of the time I took this snapshot, 23.30. It's not that price anymore. Let's go to VixCentral.com. We can see it in real time. And notice there are 8 VIX futures contracts trading at any given time. The graph of the various futures across time is called the VIX futures term structure or the VIX futures curve, because it has a curve. When the futures curve is upward sloping, it is said to be in contango, upward sloping, upward sloping. So this is a picture of a VIX futures term structure in a state of contango. So this front month contract or December VIX future is in contango. The value of that contango or the percentage of that contango, right, as of the time I took this, was 8.8%. What does that mean? Is it good? Is it bad? I'm trading. What should I know? We will get into that. Don't worry. So again, when the VIX futures curve is upward sloping, it is said to be in a state of contango. When it is downward sloping, it is said to be in backwardation. When a market is in contango, when this futures market is in contango, it describes a situation in which the delivery price of a particular future, the December future, has to converge downward to meet the spot price. What is the spot price? The VIX spot price. This is the VIX right here. This is the December futures contract. It's in contango. Over the life cycle of this contract, which is generally about 30 days, a VIX futures product is a duration product. It only has a specific life cycle, if you will, and then it expires. The VIX doesn't expire, but VIX futures expire. So over the course of the VIX futures life cycle, it has one job. It only has one job. It has to converge onto the spot price of VIX by its expiration date. So every single day, if it's in contango, it is going to converge downward to meet that spot VIX price. Every day it'll decay in value little by little until it expires. All right. A market that is in contango indicates the forward or futures curve is upward sloping. If prices did not converge, like if this did not converge onto this spot VIX price, It would set up an opportunity for investors to profit from an arbitrage situation. Contango situations can be costly to investors holding net long positions in the futures. This is why I say most people who do participate in VIX futures are participating from the short side, knowing that most of the time the VIX is rather complacent, if not moving down. So VIX futures, if their number one job, their only job is to converge onto that spot VIX price, they will also be moving down over time. Folks that are going long VIX futures, independent traders that are going long, hedge funds that are going long VIX futures, they're trying to time something in the market, which is a bad discipline in and of itself. Maybe they're trying to hedge. But again, when we're talking about these derivatives, the further that you get from the primer, something that we reviewed in our last episode in part 1, the further that you get from the primer of the VIX products, this is the primer, the S&P 500, the less relatable or the less of a relationship that product has with the S&P 500. So if we're making the argument for a hedge fund or an independent trader that wants to hedge their overall equity market exposure in case the market does go down, doing it with VIX futures is not a good idea. It's just not. This is the S&P 500. If this is going down, more than likely we're going to see a lot of put volume. But VIX futures are way out here. They're that far from the S&P 500. They may not rise in accordance with the VIX and the drop in the S&P 500. There's not that perfect relationship between VIX futures and what the S&P 500 is doing. It's not an ideal hedge. It's just not an ideal hedge. And remember, the products under management or the assets under management for a VIX exchange traded product, which is way back here in this whole derivative chain, if you will, more than likely they're not going to do what you think either if you're using these as a hedge, because the assets under management are VIX futures. VIX is a bad hedge. It's been popularized as a hedging complex, but in general, some 80+% of VIX hedges failed to achieve the job they were intended to do. They take a loss. And why? You need the right product. You need the right strike. You need the right entry. You need the right duration. You need the right exit. You need the right premium. It's a lot you got to get right for a hedge, which is why it rarely works. VXX and UVXY. Man, you ain't got no alibi. You ugly. Come on. If you don't like that, I can't help you. Wildcats, 1980s, UVXY, VXX. These products, if you don't understand how they work, they're going to do a lot of damage to your portfolio. They're going to make it a very ugly situation for you. VXX and UVXY hold a combination of the front two VIX futures. The two futures are weighted so that the weighted average represents basically a synthetic 30-day future. So they take the front month VIX future and the back month VIX future as a weighted average in UVXY portfolio, so that it's basically one product. You know, both the December future and the January future will act essentially as one product, you know, under management within the UVXY assets. And as they go, UVXY will go. This is an up-to-date, this is live, real-time right now. This is VIX Futures term structure at vixcentral.com. It's a very good resource. If you are trading UVXY, if you are trading VXX, if you are trading VIX Futures, this is a really good go-to resource. It shows you, in real time. It updates every 60 seconds so that you can see the movement of each individual VIX Futures product all the way out to July 2021. So notice what's happening here as I move my cursor over each product. You'll see that there's an expiration date there. 139 days, 167 days, so on and so forth. For the front month contract, look at that, 13 days. In 13 days, this contract will expire. This futures contract will expire. Right now, the value of it, $22.73. And to my point earlier, that's not what we saw in my screenshot from just a couple days ago, $23.30. The VIX was down here at $21.56. In real time, today, the VIX is 21.04, and this futures contract, remember, it has one job. It has to converge onto the VIX by its expiration date, which is in just 13 days. This contract, let's say it had 30 days. It only has 13 days left. That's not trading days. That's calendar days. Calendar days. When we come back on Monday next week, it'll only have 8 calendar days left before expiration. So we have a bit of a difference here. That December futures contract is 22.70, but the VIX is 21.04. The difference between those two values is what we call roll yield. You just subtract the two, 22.73 now from 21.04. For round number sake, let's call it $1.70 roll yield, which is, for this late in the cycle, less than 2 weeks to go, and what is typically a 4-week or a 30-day calendar cycle. That's pretty good roll yield. It tells you it's got a lot of decay that has to happen. There's another way of looking at this as well. The VIX Futures, the folks that are holding these VIX Futures in their portfolio are saying, we're not selling right now. We believe that the VIX is going to come up to converge with us, at least to some degree. So there's two different ways of looking at it. However, 85% of the time, VIX Futures are in a state of contango. So if you are holding that belief that the VIX will come up and converge onto or move higher to where this convergence, this roll yield that we have currently won't be as much by the expiration date, the probabilities are not in your favor. 85% of the time, VIX Futures are moving downward through their expiration. So do keep that in mind. The contango right now is at 6.62%. What does that mean? Hinted at this earlier, and here we are now. Remember, this is a state of contango. The futures curve is upward sloping. Upward sloping. Now, the individual contracts don't necessarily have to be. Each contract is its own entity. Contango is the difference between two contracts. So from the December contract to the January futures contract, that's contango. That's contango. And from the January futures contract to the February futures contract, you have some contango as well. You don't have quite as much as you do from this contract to that contract. We can see it plainly. The distance between the January future and the February future is not quite as big as the difference between the December contract and the January contract. You're going to usually have the most contango at the front month because that is the more active contract that's traded. And that's the one that's quote unquote in the queue. It's the most live contract. It's one that's going to get the most volume. Traders are trading that front month contract. Most of the time, you're going to have a premium in futures. People, for whatever reason, are of the opinion that volatility will rise over time. as opposed to fall. And frankly, that's necessary to sell a product like a VIX future. They have to have some kind of premium. In a sense, you have to start with an arbitrage opportunity for people to engage in that product. You need to develop a market. The best way to develop that market is to introduce a premium. So VIX futures, when they start, will generally trade at a premium to the VIX. They will trade at a higher price or a higher value than the VIX itself. All right. So there are two futures that are weighted. So we know that UVXY is holding both a December future and it's holding January futures contract. The two futures are weighted so that the weighted average represents a 30-day VIX future. Two factors lead to the long-term decay of VXX or UVXY. The first, the VIX futures curve is usually in contango. We just looked at the curve. We know that UVXY holds two VIX futures contracts, the front month and the back month. And over time, if the VIX is not rising, they're falling onto the VIX. So that's the first way that UVXY and VXX are decaying in value over time. And remember, each futures contract settles into the spot VIX price. And as each day passes, obviously, each futures contract gets 1 day closer to expiration. This causes the futures to pull down to the spot price of the VIX as they get closer to expiration. So when the futures are in contango, let's assume the VIX stays flat, the futures will lose value as they get 1 day closer to spot VIX. In other words, each day, VXX goes from representing 30-day volatility expectations in the future to representing 29 days volatility. And this action of rolling down the VIX futures curve day by day causes a drop in the price, or what I refer to as decay, valuation decay of VXX and UVXY. The returns from this rolling down of the VIX futures is otherwise known as roll yield. The second way these products lose value, UVXY and VXX, is the volatility risk premium that I just mentioned. This causes VIX futures to overestimate the future spot price of VIX. All of these futures, you can trade every single one of them today, but notice where they are. They're trading at what we call the volatility risk premium. They are higher. They are overestimating the future price of the VIX. So those are the two ways that you inherently see the decay value of UVXY or VXX. Using VIX Central, VIXCentral.com as a tool in the VIX futures term structure here, we can look at the previous closing price of these VIX futures. We'll just click on it right here. And as you can see, not much has happened. The previous one is in the gray, and we have the light blue, which is today's prices. So if we scan back over, right now we're at 22.85 today, but yesterday, 22.82. It's actually slightly higher than where the price was yesterday. The back month contracts are a little bit lower in value. The January was at 24.43 yesterday. Today, 24.27. So the back end has moved down a little bit. Now here's something else you have to understand. If you are trading UVXY or VXX, and we'll speak mostly to UVXY because that's what I trade mostly. I own short VXX and have since 2018. And it's gone basically nowhere. But I shorted it at a very high price. So anyways, and I'm going to benefit from long term, which is it's always going to seek out a lower price, just like UVXY is always going to seek out a lower value over time and before it reverse splits. So in referencing that this only has 13 days, the December contract only has 13 days to go. Now, every single day, ProShares, which is the creator of UVXY and SVXY, which is another volatility exchange traded product, they're selling the front month futures contract and they're buying the back month futures. Remember, they have to have a weighted average in the portfolio to basically keep it alive and keep the net asset value. So they're selling the front month and they're buying the back month. When you sell the front month contract at a lesser value and you're buying the back month contract at a higher value, that's contango. And remember what we talked about in our part 1 of this 3-part series. Don't bring your traditional understandings, of other markets into the volatility complex. It doesn't work the same. You benefit from UVXY selling at a lesser price and buying that back month future at a higher price. We can go to ProShares and we can look in real time to see the assets under management. And they're selling these because, they know every single day this is decaying in value. They want to be out of this by expiration date. It only has 13 days to go. So as they're selling the front month and they're buying the back month, that means over time, they're going to have more of the back month contract and less of the front month futures contract. It's a weighted average that they're managing over time. So we go to ProShares here. This is their website. You can just scroll down. This is all their volatility ETFs. You can see there's SVXY and here's UVXY. And that's the one we're going to click on so that we can kind of bring this conversation to light in real time and see how things are working. We scroll down here and we want to know what the daily holdings are, the assets under management. Keeping in mind that this used to be a 2x leveraged instrument, but it's now, and since Volmageddon in 2018, just a 1.5 leveraged instrument. So we'll open up the daily holdings. And this is as of the close yesterday, and it'll update every day after the close. We can see here, CBOE, VIX Futures, the December contract, CBOE, VIX Futures, the January contract. Remember, they hold a weighted average of the front 2-month contracts. The front one is December. The back one in this particular understanding is January. But when people talk about it, they say the front 2-month contracts as opposed to all the, the other 6 contracts that come thereafter. And right now, narrowly, just narrowly, there are more December contracts than there are January contracts. 41,000 versus 37,000 contracts under management. Now, at the beginning of the December futures cycle, which had about 30 days, we'll call it, because that's the average life cycle of a VIX futures contract, there was no back month contract under management on day 1 of that December future cycle. It was just the December future and Goldman Sachs swaps. So we talked about the deleveraging of UVXY that happened back in 2018 after the Volmageddon event. How did they deleverage? They simply own less VIX futures and increase their ownership of swaps. So instead of it being a 2x VIX futures, short-term VIX futures products, it's 1.5 VIX futures, and they own swaps. Swaps you don't have to worry about. They're just very constant. The VIX futures are the static portion of the portfolio, and that's all you focus on, the static portion of the portfolio of assets under management. So again, ProShares, just scroll down to the volatility ETFs, click on UVXY, scroll down again, go to daily holdings, open it up. So tomorrow, if you're going to come back here, you're going to see probably 2,500 to 3,000 less of the December futures contract and 2,500 to 3,000 more of the January contract. Every day they're selling the front month, buying the back month. So they're going to have almost a 50-50 split come tomorrow. Remember, they want to be out of this December future contract and all in on the January by the expiration date of this December contract, which is in 13 days. And that's the operation of the ETF. As long as we stay in contango, over the life cycle of this VIX future product cycle, you should see decay in the value of VXX or UVXY. Today, right now, it's basically flat. And again, the biggest reason is because most of the assets under management right now are that front month contract. And as we discovered earlier, it's slightly bid today. It's up slightly, about 3 cents. And that's why this hasn't moved. I mean, it's basically flat on the day. As VIX futures go, so will UVXY. It's a perfect example. The VIX is up. The VIX is up. But they're not a one-to-one correlation with the VIX. It's the VIX futures that guide the path of UVXY, and it's only slightly bid right now. Well, then why aren't the VIX futures following the VIX? Well, one of the things you have to know, and what I touched on earlier, is volume. Options market, right? Because that's what the VIX is calculating. The S&P 500 options market. Hundreds, millions of options are being traded every day. It's not the case with VIX futures. They don't move as fast. They can't. They're not trading with a lot of volume. This is the CBOE's website for VIX futures product. Let me hit the refresh here really quick, and we'll see what the volume is on these VIX futures. Scroll down, and there we go. That's it, folks. Right there. That's it. This is the December future, 12/16. It's down now. Well, as of the last reading, because this is going to update every 60 seconds as well, it was down 2.5 cents to 22.80. Only 32,000 contracts have been transacted here today. 25,000, almost 26,000 of the January future contract, which is down about 12.5 cents here today. They don't move as quickly as the VIX. And one of the reasons why is right now there's no real fear out there, apparently. I mean, the VIX is up 47 cents, but you still have all this space here. The roll yield that we talked about, VIX futures don't really have to do all that much. They can absorb this upward move here on the VIX today without doing anything. The people that own them are saying, we're going to wait. I mean, the VIX is up a little bit, but that doesn't make me want to buy more VIX futures. Still have a $1.57 roll yield here. It can absorb this move higher in the VIX right now. The people that might have the inclination to short VIX futures are probably saying, well, there's 13 days left in this contract. The market is quite overheated, overextended, if you will, frothy. Do we really want to short more VIX futures in this environment either? So there's kind of that, tug of war going on there. And to my point, it's not creating any real volume. After watching VIX futures trade for the last 6-7 years, I know this is very light volume. The average daily volume for a front month VIX futures contract can be 45,000. This is a lot less than that. And we're, almost at the end of the trading day. So today's a perfect example of not holding hard and fast to the belief that if the VIX is up, why isn't UVXY? They're not correlated directly. And they will only move in accordance with VIX Futures, which, as of today, have a good gap here for which they can absorb the upward move in the VIX today without doing anything more than basically being flat on the day for these, VIX Futures here, these front month contracts. So hopefully that, helps with the understanding of, why and how VIX exchange traded products do what they do. All right, some other principles. There's another key point I want to make with regards to VIX Futures term structure. VIX Futures term structure is not an indicator. It is a risk management tool. It helps to define the probabilities for VIX Futures prices going forward and with respect to the individual life cycle of that VIX future. It is not an indicator. Term structure, VIX Futures term structure is not an indicator. It's a risk management tool. If you are shorting volatility, if you are going long volatility, it is a tool that helps you to better understand the probabilities for VIX Futures prices as they get closer to expiration. That's it. It's just a tool. So in using this as a tool, we've got let's call it 6.5% contango. We've got 13 days left to go here in the December futures product. Do I want to go short UVXY with this amount of contango or downward? Well, here's another thing. You'll hear often that, people say, well, contango is going to force the price down of UVXY. It's hard to say firmly that that's not the case, but it's more accurate to say contango doesn't force price down. It's simply a metaphor. Contango is like an anvil. It's like an anvil. Anvils are heavy. Imagine putting, that on top of a physical price of UVXY. UVXY can still go up, but that anvil is going to put a lot of price suppression on that upward move. That's contango. It doesn't force it down, but it acts as like just a massive weight on upward price mobility. It suppresses price appreciation. The natural order of the VIX complex and the volatility risk premium are more of a factor when it comes to the downward pressure on VIX futures and therefore UVXY or VXX. But in kind of keeping our risk management definitions and understanding when it comes to VIX futures, I like to think of contango as an anvil on the back of UVXY. It just suppresses its ability to move higher in price. All right. So one of the reasons why I stress the whole understanding that this is a risk management tool and it doesn't define whether or not you should go short or long volatility. I had seen this this tweet the other day. Note that VIX futures term structure is indicating a somewhat notable jump in risk as we slide into January. Now, this person is saying this because all the other future contracts are way up here. On face value, he's saying the right thing. But the VIX is not an indicator. If it were an indicator, he would be right more often than not, right? Because he's saying the right thing, except he's using the word indicating. That's not realistic. VIX futures don't indicate anything because they have a built-in volatility risk premium. They will generally trade at a premium to the VIX itself. So it's not an indicator. These products, more often than not, are falling in value over time. They're not rising in value over time, and the VIX is not rising in value over time either. The VIX can have an intermittent spike, but it's not going to maintain that spike. It can't. It doesn't have that ability. The market can't function with persistently rising volatility or volatility that remains excessively elevated. We saw that earlier this year in 2020 with the VIX jumping, to 50, 60, 70, its highest closing value in history, above 82. What did we have? We had, limit down days a couple times, 3 or 4 times, I think, back in March. Markets can't function that way. That's why we have the limits where there's no trading for the next 15 minutes. The markets cease to function in that kind of environment. It's not hyperbole. The market cannot function in persistently or elevated sustained volatility. Markets can't work that way. Nobody would put their money into that environment. Volatility has to remain and come down after spikes and go through a long period of dormancy or complacency, if you will. That's homeostasis for the overall market. So to reiterate, VIX Futures term structure, they don't indicate anything. They simply denote the volatility risk premium inherent for VIX Futures contracts. If this was indicating somewhat notable jump in risk as we slide into January, then it would be right more often than not. The VIX would jump more often than not, but that's not the case. It does not jump more often than not. It maintains its contango some 85% of the time. And again, we can go to VIX Futures term structure at vixcentral.com. We can pull up contango using the contango tab here, and we can see that. The historical contango picture here, folks. Loading. All right, well, let's load, buddy. Now, I think we have it here also. And there you go. All right. Contango per year for VIX Futures, meaning that more often than not, we have an upward sloping VIX Futures term structure where all of these contracts over time will converge downward onto the VIX. 2008 was an outlier year. It was basically 50-50 contango versus backwardation. That's an outlier year. 2009, 68% of the time, VIX Futures were in contango. Technically, that's an outlier year also, but a majority of the time it was in contango, meaning VIX Futures were falling onto spot VIX throughout the year. 89% of the time in 2010, 65, 11, 94% of the time in 2012, 92% in 2013, 85%, 78, 80, 95% of the time in 2017, 63% of the time, 87% of the time. Most of the time, VIX Futures are in contango and they are moving downward, decaying off of that volatility risk premium for which they originated. So again, suggesting that VIX Futures term structure is an indicator is just the wrong way to approach trading the VIX complex. It's simply a tool that identifies risk. There you go. 2018, at the end of 2018, we spent a good amount of time in backwardation. This year in 2020, we've spent a good amount of time in backwardation. But over the last couple months, we've been in contango. But you can see it's very brief periods for which we are down below the zero line, which is the divider between contango and backwardation at the bottom. You're only there for very brief periods of time because the market is enduring some type of volatility that it cannot spend a lot of time dealing with. And before we eventually get back to a homeostasis in the market and a normalized VIX futures term structure right now. And I've seen this thrown about. DataTrek wrote an article just the other day. VIX futures term structure. A bit of a smorgasbord of data topics, but the first topic they touched on was this is the one time of the year where you have to look at the entire VIX futures term structure rather than just the front month prices quoted in the financial press. The implied volatility embedded in options prices, what the VIX actually measures, is seasonal and typically declines in the back half of December, which we've seen that from November to after the election. We saw the VIX drop, we saw VIX futures drop, so there is a seasonal aspect to it, and it typically does ring true through the Santa Claus period, if you will. And here was when they took a snapshot of it. So the 2 points that they want to discuss. First, the January to July, so it's all these back month contracts here. January to July, VIXs are all noticeably higher, $25 to $26 range, than the spot VIX itself here. This is notable because the VIX's long run average back to 1990 is just 19, the median 19. And the 2021 prices are above that level. This indicates, and here we go again, it indicates that options markets believe U.S. equity volatility will remain elevated through the first half of next year rather than revert to their long run average indicates. So here's what I did. We've been in this period since the March bottom in the S&P 500 and the VIX, where we've followed extremely closely the 2009 analog. Remember, in 2009, the S&P 500 bottomed and rose more than 60% the rest of the year into 2010. The VIX did the inverse correlation, which it descended in 2009 through the end of the year. So let's go to the VIX. And we do these kind of exercises in the Phenom Group trading room with our members, our premium and mastermind options trading members. We do these exercises as a form of research to, know what we're in for. We plan ahead. We want to think, we want to be forward thinking, when we see these kind of narratives out there so that we can be prepared. So we're going to go from 2009, January, to the end of the year. And we're going to look at the VIX back then. And here we are. But this isn't enough, right? This is the analog. It looks just like this year. Looks just like this year. We had the blip in November. We had the blip this year in November before it completely died off. We did not break 20 in the VIX in 2009 until the final week of the year down here. That's it. So when people are saying, there's something wrong here with the market, look at the VIX is still above 20. Nope. Following the 2009 analog. Know your history. Nothing's wrong. It's just following history. Remember, the circumstances are different today than they were coming out of the financial crisis. But human behavior, folks, you can find it very repeatable. It's repeatable in what we're seeing in the VIX. It's repeatable what we're seeing in the S&P 500. So let's fast forward a bit more because we're talking about VIX futures. So let's move out into 2010. Let's see the first few months, because if we're talking about VIX futures, let's go out to March. There's 31 days. Let's go out to March 2010. Apply. We'll look at that. 2009. We had a bump early in the year in January. But man, fade. We're right back down to 20 going into, we got up to, what did we get up to here? 28 was the high, and it closed there. And we got a 26 here, and then it just died big time. Back down to 20, and it just kept dying in April and into March. Die. Basically, the end of March. We're in the 16s here, folks. We're in the 16s in March. You had a blip on the radar. We want to make note of that, because if we are looking at VIX Futures term structure, they're up here in the mid-20s. But again, let's look at historical prices. So let's go back to 2010. First, again, take note where we are, 24s to 20, let's call it 26, right? 24s to 26. And yet we saw volatility continue to run down through the first quarter after the blip, just a little blip. After the first quarter, we saw volatility continue to decline through March. Through the end of March, the VIX continued down to 16s. So if we go to historical prices, let's get to 2010. Let's go to January. Let's see. We'll go mid-month, right? Okay. And get prices. Same thing. Same thing back in 2010 in the beginning of the year, folks. Look at the curve. Still have contracts all the way up here in the 20s in January. Let's go out to February. Oh, we got to put a 12 because it's not going to register. There was no 13 trade. Get prices. Look at that. VIX futures were still elevated in February. And let's go to March. Look at that. They're still coming down. They were wrong. They were wrong. VIX futures were wrong. As late as March, we'll go to the end of the month on the 31st, because that was a trading day there. Continued to come down. So no, VIX futures aren't indicating. They're not heralding. They're not forecasting. It's just the nature of VIX futures. They have a volatility risk premium that is often wrong. And the natural order of the market is to find VIX coming down in value over time, VIX futures coming down in value over time, UVXY decaying over time. We are seeing the exact same setup from early 2010 as we see with the current shape of VIX futures term structure. It's not appropriate to say they're an indicator. It is appropriate to do that exercise that we just did here in real time. Should we expect a volatility spike in the first month of the new year? Hey, again, we rely on history as our guide because human behavior just doesn't differ that much. Doesn't. Circumstances can, but that doesn't mean human behavior will. And it does suggest we anticipate a mid-month, a mid-January spike. It's not going to be, it may not be the same days, the same week, but around January, you might want to start anticipating a bit of a spike in volatility. If it doesn't come to pass, it doesn't come to pass. But that's VIX futures for you. That's how UVXY, that's how VXX operate. That's why it's important to understand these nuances of the VIX complex if you choose to trade volatility. And that's part 2 of our 3-part series, folks. I thank you for joining us again here today. Whoops.